In early 2021, the global pandemic had forced Kenya's economy into a corner. As businesses collapsed and incomes dried up, even established professionals found themselves scrambling for survival capital. One of those professionals was Matthew Kyalo Mbobu, a distinguished lawyer and lecturer. To weather the crisis, he took out an emergency loan of 11 million Kenyan shillings from a private investment firm. The terms attached to that cash were brutal. The contract demanded a 15% interest rate every single month, heavily penalized by a 5% weekly fee for any delays in payment. This graph illustrates exactly how dangerous those terms were. What looked like small weekly and monthly percentages climbed aggressively through compounding math, dwarfing the original 11 million shilling loan to hit an annual interest rate of over 400%. At that speed, the math itself turns a lifeline into a closed loop, ensuring the debt grows faster than a borrower can possibly repay it. Mbobu was far from the only citizen caught in this kind of labyrinth. Across the country, thousands of languishing borrowers were quietly sinking under the weight of debts issued by unregulated shadow lenders and microfinance institutions. These private financiers operated behind a legal smokescreen. Because they weren't officially registered as traditional deposit-taking banks, they argued they were exempt from standard interest rate caps, claiming their terms were protected by the freedom of contract. That same logic bled into government-backed student lending. One university student borrowed 82,000 shillings from the Higher Education Loans Board, only to watch the interest and penalties swell the balance to over 540,000 shillings across 12 years. Once a borrower defaulted, lenders would leverage these artificially inflated debts to legally seize physical assets, forcing family homes and businesses onto the auction block to cover the impossible shortfall. The entire system relied on a specific premise, convincing borrowers that signing a loan contract meant a total surrender of their legal and financial rights. But Kenyan law actually contains a statutory weapon explicitly designed to stop runaway debt. It's found in Section 44A of the Banking Act, commonly known as the In Duplum rule. This diagram demonstrates the core mechanics of the rule. When a loan officially becomes non-performing, the interest bar rises to match the principal bar, hits a hard legal ceiling, and permanently freezes. Under this framework, the absolute maximum amount a lender can legally recover is strictly limited to double the original principal borrowed. For years, a massive loophole existed. Previous court decisions, like the Momentum case, ruled that this strict cap only applied to regulated, deposit-taking banks governed directly by the Central Bank of Kenya. As a result, corporate bank customers enjoyed robust legal protection, while vulnerable citizens borrowing from microlenders and digital apps were left exposed to infinite interest loops. That structural imbalance began to collapse inside the Milimini law courts, as the judiciary systematically pierced the corporate smokescreen deployed by non-bank lenders. The initial turning point arrived during the HELB student loan case. The High Court declared that allowing unchecked interest to accumulate was inherently discriminatory and directly violated constitutional protections against unfairness. Then, during an appeal involving Faulu Microfinance, a judge crystallized a new legal reality, formally declaring that borrowing is borrowing, regardless of whether the money comes from a traditional bank or a private lender. The court's logic was straightforward. If the financial devastation to the citizen is identical, the legal protection shielding them must also be identical. This judicial pivot shattered the shadow lender's primary defense. It expanded the In Duplum shield to cover the entire Kenyan credit market, enforcing the law based on economic reality rather than rigid corporate technicalities. We apply those same numbers to Matthew Kyalo Mbobu's 11 million shilling crisis. This equation shows exactly how the court evaluated his debt. Because Mbobu had already paid 22 million shillings on his original 11 million loan, he had exactly reached the limit of double the principal, zeroing out the balance. The court immediately deployed aggressive remedies, voiding the exploitative contract, permanently halting the auction, and ordering the return of his family home within 30 days. The ruling was absolute. The private investment firm was legally barred from attempting to collect even a single additional shilling from his estate. The ruling turned consumer protection into a physical barrier against foreclosure, pulling a family's primary wealth back from the edge of liquidation. That translates into a massive shift in leverage for the average Kenyan utilizing modern, non-bank credit systems. Lenders now face a stark new reality. Attempting to profit from unconscionable interest rates exposes them to massive financial losses and opens the door to potential criminal liability. Predatory terms in a contract cannot sign away a borrower's constitutional right to a fair bargain. Across the entirety of Kenya's financial sector, true economic fairness has now become a strict, legally enforceable mandate.